MercadoLibre just hit $10.2 billion in quarterly revenue for the first time, yet Wall Street instantly dumped the stock after hours. Welcome to Earnings Unscripted, where we pull apart what the market's actually reacting to. It's August 5th, 2026, and we're unpacking MEL's second quarter.
Yeah, it's the classic growth versus margin panic. Revenue was up a massive 50% year over year, but earnings actually fell backward to $9.19 a share. Investors just hate seeing profitability slip while the top line explodes.
Right, and you really saw that anxiety in the tape. The stock gapped up going into regular trading. It mostly chopped around sideways all day and then just fell off a cliff the second the report dropped. It caught a slight bid during the earnings call, but still closed solidly in the red.
The tape usually overreacts to short-term pain. Although, before I defend their spending habits, I should point out our analysis today isn't formal financial advice. But honestly, the initial sell-off makes complete sense if you only skim the surface. Management completely wrecked their own gross margins this quarter, mostly on purpose.
Okay, wait. Wrecked them on purpose? Because for the largest e-commerce and fintech platform in Latin America, you'd assume they'd want to show serious operating leverage by now.
They do, but they're playing a much longer game here. They're willingly swallowing huge upfront losses right now. They essentially imported a massive volume of physical card readers to restock their merchant network in Mexico, taking the whole cost up front. And they also dropped their free shipping thresholds down in Brazil. So they're taking the hit today just to force more transaction volume through their system.
So they're heavily subsidizing the ecosystem walk-in.
Exactly that. Once you get a small business operating on your fintech hardware and shipping through your logistics network, they rarely leave.
That makes sense, but funding that level of subsidy means you need radical cost cutting somewhere else. And looking through the transcript, the CEO claims they actually froze their engineering headcount because AI is writing most of the code now, and I really need to know if that's truly happening or just a neat story for the analysts.
No, it's a real shift. They're basically using AI as a bulldozer for tech bloat. According to management, 2026 is the first time in years they're not expanding the engineering team at all.
At all. But with the massive top-line growth we just talked about, you'd think they'd be hiring developers as fast as they can.
Right, but listen to how CEO Ariel Sarfstein framed it. He literally said human-written code is the exception. The majority of the code is done by AI, and you can see that also flowing through our P&L.
Okay, wait, walk me through that. Is that why their product development expense dropped down to roughly 7.2% of revenue?
Exactly. And it gets wilder on the customer support side. Transaction volume tripled over the last 4 years.
Wow.
But 90% of those user interactions are handled completely without a human now.
Oh, wow. So they just don't need the payroll footprint.
Yeah, they actually shrank that specific service team down to 7,000 reps. And for context, they used to need 10,000 just to run a much smaller business.
I mean, Wall Street generally loves that kind of brutal efficiency. But if they're saving so much cash on salaries, it makes that steep profitability drop look even stranger. Where's the cash actually bleeding out?
It's those point-of-sale devices we brought up, the card readers. There's a permanent margin headwind hidden in the hardware itself, completely separate from the aggressive inventory rollout.
Wait, permanent? Because earlier I thought the margin hit was just because they ordered too many physical scanners for the Mexican market all at once?
That massive restock just caused a temporary one-off squeeze. The CFO pointed out we sell those devices at a loss. We need to book the losses up front. But the deeper issue is global memory chips.
Oh, got it. So it isn't some volume penalty. The actual microchips to build each reader got permanently more expensive.
Bingo. The raw materials stepped up, but instead of raising hardware prices for the local shop owners, MercadoLibre chose to eat the inflation.
Because if you jack up the scanner's price, the merchant just buys from a competitor, and then you completely lose the ecosystem trap they're setting.
Exactly. You lose the payment volume, you lose the software lock-in, and crucially, you miss out on the lending relationship.
That's clearly the real prize, considering they just expanded that total credit portfolio by a massive 75% year over year.
Yeah, and here's where I fully expected to see disaster. When you push out that many loans that fast across Latin America, the default rates usually blow up in your face.
Right, because you're approving riskier borrowers just to show Wall Street you have scale.
Precisely. You scrape the bottom of the risk barrel, but their early stage defaults didn't spike. They sat right near historical lows, which is that's honestly wild when you look at how panicked other regional lenders are right now.
That makes me wonder how long that underwriting magic can really hold up if the Mexican consumer starts seriously pulling back.
Yeah, that's exactly the risk here. Management actually admitted on the call that Mexico's momentum is facing real headwinds. There's a new tax reform down there, plus a generally weaker consumer backdrop. So if that softness spreads, that pristine default rate gets tested very quickly.
Right, because you can only outrun a bad macro cycle for so long before your borrowers start feeling it.
Exactly. But management honestly they're not flinching. They explicitly refuse to give formal short-term earnings targets, which Wall Street obviously hates. Instead, they just told everyone they're keeping their foot on the gas, aiming to sustain their cross-border trade growth at around 60%.
So they're completely ignoring the traditional playbook of pulling back when things get choppy. I mean, between aggressively swallowing hardware costs and, keeping the AI investment so high, it feels like they're just using their balance sheet as a weapon, like they're daring competitors to try and outspend them right now.
That's basically the strategy, yeah. But looking ahead, the main unknown is definitely that loan portfolio. As those massive blocks of new issuances hit the 90-day mark, we'll see if their data-backed underwriting actually holds up or if they just bought market share with bad debt. You can subsidize a shipping route, but you can't subsidize a bad loan forever.
That's a perfect way to put it. Well, it's an incredible story of ecosystem dominance, even if the near-term profitability takes a deliberate hit. Thanks for sorting through all these puzzle pieces with me, Miro.
Always a pleasure. Catch you later.
If you enjoyed this breakdown, make sure to hit subscribe so we can catch up next time. And since we spent all that time talking about MercadoLibre replacing human coders with AI, it's only fair to admit this entire podcast is completely AI generated. Synthetic voices and script included, getting this analysis to you the very same day. Drop your thoughts or the next ticker you want covered over to earningsunscripted@datamadness.ca. Thanks for listening.